Hello and welcome to HSC Business Studies Lesson 6 on Finance. Today's lesson, or this particular lesson, we're going to start looking at the processes of financial management. A lot of this you already know. It's talking about the kinds of things that finance has to do to manage the finance of a business. As you know, one of the main things that a finance department has to do is to plan and implement the goals of finance for the business. This is called financial planning. You need to identify the financial needs of a business. So decide what the business needs to do from a financial perspective. Do they need to manage credit? Does that mean that they have to manage the people who owe them money? Ideally not to use factoring because it's an expensive form of debt. To manage the payments, to make sure the payments are paid in 30 days. To look at how they would invest their money and to make sure that all the financial transactions that they are doing are done correctly. This is called auditing. A finance department will also have to do budgeting. This is a forecast into the future to see what they plan to spend and then to measure that against their actual financial outcomes. Budgeting is one of the most important parts of a finance department because it tells a whole company how much they can spend, and then it looks to see how they've measured that against the actual. Some of the things they have to do is to keep records. In years gone by, those were kept on paper. Now they're kept on computer systems. A company called MYOB developed a great accounting system which a lot of businesses use. A lot of businesses design their own accounting systems. They create policies and procedures to tell every employee how to manage the finance of the business. They also have financial controls. They have systems in place to make sure that the financial transactions and plans are done correctly. If they're ever audited or they're ever checked by ASIC, which we talked about in the last lesson, then they can show that they have specific plans in place. One of the big areas that you need to know for HSC Business Studies is an area called gearing. It's a process in financial management where finance managers decide how the business is structured from debt to equity perspective. Gearing, quite simply, is how much debt capital a business has compared to the equity capital. It's sometimes called leverage. You hear it sometimes on the news when people say they're very highly leveraged or they can leverage this. If you look at the diagram, you see some cogs with dollar symbols on them. This is a really good example of debt to equity. A standard across all businesses is ideally 1-to-1, 50-50. So every $1 of debt that the company decides to take on board, they will get $1 of equity invested into the company. If a company had a gearing ratio of 2-to-1 instead of 1-to-1, that would mean that they've got too much debt. They've got $2 of debt for every $1 of equity. Now, as you remember, businesses that take on debt have to pay interest. Businesses that take on equity is a longer term source of funds. It's very important for a business to make sure that they have the correct ratio of debt to equity. If you read page 180 of the text, which is called Gearing and Leverage, you'll see a lot more detail on this area. I suggest that you do read that and summarize as much as you possibly can. So let's talk about debt and equity finance. Debt finance has got advantages and it also has disadvantages. The great advantages is that the interest that you pay on debt finance, so borrowing money from the bank, overdrafts, factoring, you can pay the interest, but you can also deduct that from your tax at the end of the year. It's usually simple to acquire. You go to a bank and you apply for a loan. You can negotiate the different terms of the loan. You have control over doing that. And the repayments can be planned in advance. You can have a cash flow projected statement, which shows that you have outgoings at particular parts of a different year, and you know that that is the repayment on your debt. Importantly, debt finance does not decrease your ownership in the business. You do take on more responsibility, but nobody is taking over your business. So let's look at some of the disadvantages. A disadvantage can be that it is expensive. If interest rates are high, you're going to be paying very high interest rates for the money that you borrow. You have to pay regular repayments. A bank is going to want a contract with you that tells you when and how much you should pay. You usually have to put forward security, much like when you're parents or when you become older, that you have to put down some money before the bank is prepared to give you a loan. Similarly with businesses, they may have to put forward some security, the assets of a business perhaps, to say that if they do not pay the loan, those assets can be used to cover the cost of the loan. You need to have a good credit history. You need to prove to the bank that you are prepared and have a history of paying back interest and the base amount of the loan amount. And you must have good cash flow. Fundamentally in business, you must have cash flow, working capital, and liquidity. If you have that, then you've factored that into paying your debts. So let's look at equity finance. Equity finance again has advantages and disadvantages. You're not paying interest charges, which means that you can use the money to generate income into your business. Use the money for cash flow. Usually cash flow is higher and you can use it in the long term. The idea of equity finance is you will probably raise large amounts of money or larger amounts of money, and that money can be put into purchasing assets or doing things in the business that will give you a return in the long term. And the investors who give you equity, that might be a private investor, it may be shareholders, usually are prepared to wait a period of time to get dividends or return on their investment. Equity is usually seen as a long-term investment. The disadvantages of equity finance is that you give up part of your ownership for the business. If you sell shares, you're giving part of the ownership to different people. If you take on private equity, you are usually giving a majority of the ownership of a business to other people. Some of the profits that you make will go to the owners and shareholders in the form of dividends. There are no tax deductions available to businesses with equity finance, and usually the investors who invest in your business will want a higher return. Imagine they're going to invest thousands of dollars in your business. They could invest the money into a bank account or a high interest account. They need to make sure that they're going to get a return which is higher than the money they could invest into a bank account or a long-term investment with a bank or other shares. So you have to be competitive with the dividends and the interest that you pay back to your investors, to the people supplying the equity finance to you. So usually, as a general rule, equity finance costs more than debt finance. However, for a business, if you increase your debt finance, you could get into some trouble. If interest rates rise, you'll be paying more interest. If banks feel that they can't loan any more money, they'll make sure that you are paying your money and your interest on time. That could be difficult if you don't have good cash flow or working capital. The relationship between debt and equity is called the gearing ratio, and we'll be looking at that a little bit later in this course. So you need to have effective financial management. You need to make sure that your gearing ratio is correct for your business at the stage of the business life cycle. You need to make sure that you don't have too much debt or too much equity. If you read page 182, that will show you the gearing ratio. I hope you've enjoyed the lesson. I hope it makes a little bit of sense to you, and we'll talk more about gearing soon.